I believe it's more difficult to get onto the property ladder and to be a property investor or whatever it may be, even if it's just a personal home, because your salary isn't as large of a percentage as the property or value. Whereas back in those days, you might be on £4,000 per year and buy a house for £8,000 per year. Most of the south of the UK are nowhere near their targets, nowhere near 50%. We've had a -7% homes gaining planning consents in Q3 2024, -13% new homes completed in Q3 2024, -18% new homes started in Q3 2024. 18% decrease in new homes being built is a crazy stat. This is Savills Data's predictions, basically. They have predictions that it's going to go house prices. So this graph in front of us shows nominal house prices and real house prices. Now, the difference between nominal house prices and real house prices is nominal house prices is the current price of the house as in terms of the money at the time, whereas real house prices is a price house after it's been adjusted for inflation. So you can see the pink sort of boxes are the real house prices, and then the blue section is the nominal house price. This is quite relevant for as inflation fluctuates in a market, it does have quite a big impact on affordability, cost of living, house prices, obviously. But actually, what is trading in the market is also really interesting and rich data. Coincidentally, it kind of does follow, and where it kind of does follow is actually really interesting. We had a huge dip in sort of September 2023, where actually the real house price had a huge drop compared to the nominal house price, so the actual price that stuff's selling for. And I believe that's just because the market still does move. And so you can kind of see the same trajectory, which is really interesting because it is related, but it's also good to understand where the house price markets are moving. Where we currently see this is the most positive thing that you can see about this graph and take away from it is between and the early 2023, we went below house growth. So houses didn't go up in value in either space, real or nominal house pricing. It then sort of comes back up and comes out of the trough in sort of December 2023. So what you can take away from that is 2022 to 2023 was not a great year for anyone doing anything that we're doing. And actually, if you take the whole trough as a whole, so the start of the dip to now, we're still not back to the property markets that we were in the early 2022. You know, when we saw that huge growth just up, you know, in the COVID period where everyone was like, I need to move house. I think there was two things there. People wanting to live in a nicer property because they've looked at their own four walls in a property more than they ever had because of the restrictions that we had from leaving the home. But also people probably thought life's too short. You know, they probably made plans and goals with their partners while locked in and thinking, you know what, let's just go for it. Let's move to a countryside. Let's move abroad. The amount of people that I know have done that forced the housing market to change quite quickly. Back into sort of the context of it. So if you start looking at mid 2022, when I feel that sort of peak really start to come down and inflation started really impacting the cost of living in the market, all the way to now, we're still not recovered. But the most important thing is the graph is recovering, and it has been recovering for about a year. So I think the positivity we can hopefully take from this is that we stay on a positive trajectory. I know a lot of developers in this space, a lot of property investors, we don't want big peaks and troughs. We're not timing investors. In actual fact, I know no one that wants timing. Timing is a thing, and it's good to take advantage of if you know what you're doing and you can sort of live and breathe the market. But we're not here for timing. We're here for consistency, and we're here for activity. Within this report, I've delved down. I know most of our listeners are probably around the southeast, so I've tried to sort of target this area more so than others. One thing I found really interesting about this slide in front of us is it talks about the house price growth in the UK since 2007. I don't really like that they've selected 2007 because that's kind of just before the credit crunch. They probably tried to straddle that blip and take a long-term view, which actually, if you look from the graph, doesn't look that scary. But we have had a significant rise. And if you actually look at what we're looking at in front of us, it's positive growth the way through. And that's kind of the way that most people see the UK property market. We're in Ireland. We're not getting enough stuff through planning. We're not building enough stuff. Population is growing. Where is the best place to invest? Kind of most places, because you can't, like in the States, you can't build 300,000 home development village and then it's just a new access point between two development villages because they've got masses of land. We don't. And we've also got greenbelt, and we've also got areas of outstanding natural beauty. We've also got heritage areas. We've also got connection links. We've also got rivers. But what I found this really interesting to look at is actually the house price to earnings ratio. What that is for listeners out there is what you earn against what you can buy. So for an example, the average price in the UK is about £350,000, and then the average wage in the UK is 1/8 of that. I used to have this conversation with my father quite a lot because he believes the property market is easier now. I believe it's more difficult to get onto the property ladder and to be a property investor or whatever it may be, even if it's just a personal home, because your salary isn't as large of a percentage as the property value. Whereas back in those days, you might be on £4,000 per year and buy a house for £8,000 per year. So it's a 2x multiple in your salary. So what I find really interesting about this is actually analysing backwards data and where the market's going. And I think that's really good for creative ideas like HMOs. HMOs are actually a more affordable way than someone renting a one-bedroom flat. So you're supporting the growth of their deposit bank or their savings account to buy a property sooner. And it's those cost of living and changes in the market that when you spot them and provide something that the market needs, you will perform better than competitors. But what is also interesting is outside the Southeast, the ratio is 8 times the earnings, and inside the Southeast, it's 10 times. So you can obviously see that salaries don't really reflect the value exchange that you're getting in the South. Base rates. So we recently had a dip, 25 basis points down. We'll put that in the bag. I don't know if anyone else gets an email from all of their lenders letting you know that you're paying a little bit less, but normally still quite a lot. But this is Savills Data's predictions, basically. And what their predictions are is not only just base rate, it's also base rate and the anticipated average of mortgage rates. And this is probably stipulated around actually just a residential mortgage. So if you're moving into a new home with a family or on your own, but it's just you on a residential mortgage, not a buy-to-let, not commercial, this is specifically speaking for residential homes. It's obviously got the tracker on there for the exact tracking of base rate all the way up to the point of now. And they have predictions that it's going to go all the way down to 2%. So it's basically like a clean linear decline from now all the way down to about, where is it, September 2027. They're anticipating that we're going to drop a further, 2.75%. So if you did the maths, you could probably work out that that's a lot of 25 basis point reductions down there to get us down to that point, which is nice and good to see. You can also see the average mortgage rate. So we're currently sat around 4.5%, and they also believe that that will follow in a similar fashion, but slightly delayed, and get down to just below 3%. So hopefully we get back into that market space and promote positivity and activity. Interestingly, we were obviously at 0% interest rate back in March 2021, and they're not saying it's going to get back down to there. So the new norm you should put into your numbers and your figures and when you're stress testing things is not going to be back down to that 0% mark. I would actually probably say that what we're doing to stress test our deals, HMOs and developments, is we're not putting any decreases in at all. We're keeping the rate as it is, or kind of where the market is today. And if the scheme works, the scheme works. We're not baking in any further reductions. A lot of people were kicking off their mortgage offers, or offers they've received from mortgage companies and not yet completed on, didn't go down with a base rate change. But the thing is, base rate, and as discussed in the last episode, might have actually been pegged on SONIA swap rates rather than actually following exactly base rate. You've got to remember that no banks borrow directly from Bank of England. So when their rates go down, their money goes down. You've got to look at where their source of funds come from. If they buy in larger markets, they buy their finance at X, they're putting it out to you at Y. If base rate changed, their finance might not have changed. They might have locked it in for a longer period. Their lender might not have changed their figures. We obviously have that trickle effect. Our perspective, where do we see development finance? Where do we see HMO products? Realistically, back 5 years ago, we were getting HMO products between 2 and 5%, and I think they'll always fall between there for a very long time. From a development and bridging and refurbishment perspective, we're currently just below 10% as a rate. I think we'll probably soften slightly. Back when we bought our milling building, we were paying 7.5%. I don't think it's going to get that low again. I think we're realistically going to be between 8 and 10% over the next few years. But hopefully, and as I mentioned at the sort of start of this, we just want consistency. We want consistent activity that's more predictable, that puts a bit of confidence back in the market so the stock is trading, and that will aid us all to grow and scale our businesses. Basically done a bit of a summary to the outlook for 2025 and what we can expect. So 4% mainstream house price forecast to increase, and 3% in the Southeast. So Southeast seeing less growth, but you could potentially argue that we have had slightly better growth potentially than northern parts of the UK. So this map, it's kind of a heat map, but what it is telling us is over the last 4 years, people have moved to cheaper locations. That's the general consensus of this. So what you can see on the left-hand side is the house price growth. So what things are priced at. And what you can see on the right is the average transaction value. So what this is analyzing is how much stuff costs and how much it's been growing against how much it was worth. So obviously, if you drop your prices on a product, you will normally get an influx of demand. Housing hasn't always been that way in a rising market. Pick location, people pick schools, people pick being around their family, probably more prevalently than the capital cost saving. But this map actually shows that there is clear definition in the southeast where people have moved to cheaper locations. They've moved branched out, whether they were on the train for an hour to get into the city, they might be now doing 2 hours and going in less frequently. And I think this is driven by a number of things: people moving away from the city, commuting in less, hybrid working, people wanting more for their money. We kind of all knew that because second houses in Cornwall were getting bought up by celebrities and it was a talk of the town. What this is really sort of showing is that expansion of market activity and pulling it away from into the city. But I think that's going to then contract back in and level out because there's been less activity in the more expensive areas, which shows that the Savills are predicting in the southeast property values won't go up as much as the whole of the UK. But I think that there is opportunity to still think about locations that are cheaper and more desirable. B, I think that's allowing more activity in areas like where I live in Oxfordshire. But just understanding this data is really important for what stock you're bringing to the market. To condense this down and to look at who's going to be buying and who's going to be able to be buying between years before and now, we've had a 10% increase of first-time buyers, a 26% on home movers. That's also communicating what we saw from the last image. A 20% increase in mortgage buy-to-let properties and a reduction in cash buyers. So to summarize the resi market, they think mainstream housing is going up 3% in the southeast and 4% across the UK. They think it's also going to be going up 17.5% in the southeast over the next 5 years and 23% across the UK. They believe because Bank of England base rate will come down, hopefully mortgage rates will come down too, which brings hopefully more home movers into the market to breathe a little bit of activity. Individual landlords that own buy-to-let properties within their own name really struggled over the last few years. I will continue to see that happening. The amount of landlords that I know that own their real estate in their own name that are just rescinding their asset and saying, you know what, I just want to get rid of it. This is more around strategic stuff, bigger plays, and what we're doing as potentially as a country or as a development outfit to communicate with the market that we're dealing with and we've been sort of in for the last few years. This is sort of a heat map of delivery versus proposed houses needs targets. So the white sections, which is basically nowhere, shows that met housing needs are, so there's no surplus or deficit on housing market needs. And then the darker areas are over 50% below the target that they were targeted on. Most of the south of the UK are nowhere near their targets, nowhere near 50%. And that the huge challenges is in the south. So that might also be an explanation of why people are moving out. We've had a minus 7% homes gaining planning consents in sort of Q3 2024, minus 13% new homes completed in Q3 2024, minus 18% new homes started in Q3 2024. 18% decrease in new homes being built is a crazy stat, given that we've just said all of the stats say on the screen that we're not hitting our housing targets, and then all the stats on the right hand screen say that we've had a deficit in change. The trend is we're doing less. How is this going to be resolved? So huge opportunity there. Obviously it comes with its bottlenecks and limitations, planning, funding, risk, whatever it may be. Then we've got a chart which is sharing the sort of average house builder sales per outlet per week, which is a bit of a mouthful. The linear graph shows from 2008 to 2004, we had a really, really big consistent spurt up from 2008 to 2021. And basically COVID has had a huge drop off that. So that huge drop and gap and grey area is actually the reason that I believe that there's a good opportunity to get into this space and put housing into the market. This graph obviously shows that we're currently in a trough of how many developers are averaging sales. And what is that? Is that market? Is that interest rates? Is it people not moving? Is it planning's not being approved, so they're reducing their sales rate? Because developers won't build the houses if the sales aren't there. We have small brownfield sites or existing buildings in good locations. We just crack on and build them out. But for like new home building, if you're building 1,000 homes, you do have to think about how many homes are actually going to be bought in this market space. 150 a year if we take 10% of the market. That's the view that developers take, and it has been on decline. Some of that could be down to a lot of PLC builders actually stopped construction because they didn't know where the market was going during COVID. So build to rent is something that's been around for a very long time. It was actually typically kind of invented by the councils to some degree, where they would build properties and then rent them out to the local public. And that was obviously the standard council housing that were thrown up after the war to resolve a housing crisis at that time. But build to rent in this capacity is obviously very different. It's a sort of conducive scheme where they're building large buildings, renting them out, and they normally have shared amenities and spaces so that they get economies of scale in terms of what has actually been created in that space. So if we're building a 3-flat development, we're not going to have a lobby, a concierge, a lounge, a postal room, whereas this is a much more inclusive product that is actually actually in really good demand at the moment and allows those people that can't afford to buy homes an affordable place to live, because the more units they can put together for build to rent, the more that they supply the demand that is there. Land values. So I found this one super interesting. On this table, we've got the UK house prices, we've got UK greenfield land values, and we have UK urban land values. So at the very bottom is the UK urban land values. The sort of middle line is the greenfield land values, and then the red is obviously the residential house prices. Coincidentally, we always talk about like who's going to wear this change in like house price change, and we normally go, well, the vendor that owns the field doesn't really care. But what you can see is confidence was hugely dropped in 2008 when we had the credit crunch, but property prices actually didn't change so much and land values went really low. So that would have been a great time to get in at. We've got a little bit of a spike around the COVID boost around, property prices going really well, and then a decline again. It actually follows quite linearly, which is good. You will also notice that the house price and land values has increased its gap, and that is because build costs and interest rates have gone up. So what that tells us is the land values are actually reflecting across the board what eventually gets transacted on. They are keeping in line to make sure that you have the land value, but you have all the costs on top of that. So it's kind of a linear edge that goes up and gets a bit wider, which is interesting to see from a macro perspective. The three sentiments that they've put is greenfield development land has remained stable, but urban values are more challenged. In the pandemic, everyone moved away from the urban environment and into the sort of greenfield sites, but I think that there's actually going to be quite a bit of demand to come back in. I believe that might be a sort of expansion and contraction of that result. They've also said notable returns of major house builders alongside partnerships, maybe to de-risk the future of their businesses. They're actually partnering with landowners more rather than buying it and trying to make margin on planning and construction. And then last, improving sentiment following the election, but muted activity levels. I'm seeing this. I don't think we're going to see much more activity into the new year. Again, another point on significant regional variation in land values. Interestingly, Scotland has seen the biggest influx in land values, the north as well. So I believe that the north has seen a biggest change in land values because the percentage of the land value isn't too much of a difference for the build costs, whereas land values down south, you're normally getting in at a higher position. So I believe that the biggest change is in the north because land's always been cheaper. So a 4% change on a 200 grand plot isn't a massive change, but a 2% change on £1 million plot is quite a significant change in the south from a monetary value.